Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm happy to be hosting this week's topic, which is titled, How to Become a Happy Camper. The investment strategy I'm going to walk through here began with a conversation between my colleague, longtime instructor and manager here at VectorVest, Mr. Scott Baucknight, and our founder, Dr. Bart DeLito. Turns out Dr. D had seen a portfolio that Scott had created in his program that looked a lot like this. It's about a 2-year look back at a portfolio model using large cap S&P 500 stocks and adding a relative safety rating to those stocks as part of his investment strategy. Now, the unique aspect to this was that Scott had removed stocks from the petroleum sector from the equation to build this portfolio. Now, we know that the petroleum sector can be volatile. It's a commodity-based sector that can move dramatically due to many factors, as we've seen since 2014. And so it makes sense that in a prudent approach to building a portfolio, it would be wise to remove such a risk. If we go back to the views of September 23, 2016, Dr. DeLito wrote about the earnings recession myth. And in short, he commented on how the petroleum sector earnings were weighing down the overall picture of the S&P 500 earnings. Now, to look at a visual of that, if I go to the Viewers tab, here's where I could find my watch list search directory, and I can scroll down to the S&P 500 watch lists. And it was at that time in 2016 that we added a couple of watch lists to our directory here. One is the S&P 500 all petroleum stocks. So these consist of all of the petroleum stocks within the S&P 500. And then we added a list, the S&P 500, and removed the petroleum sector from that list of stocks. At the bottom of any watch list, we have the ability to look at the average numbers for the watch list, and if we right-click, we can view a graph of those averages. So what I've done is put up a 5-year look back of the S&P 500 without petroleum sector, and can click here and see the earnings per share progression as we look at the S&P 500 itself. So we can see that steady rise in both. Now, up in the upper left-hand corner, I have the ability to choose a different watch list, and let's go ahead and compare to the S&P 500 petroleum sector over the same time frame. So when I scroll down, I can come down to my all petroleum, which means this is a graph of just the petroleum sector over that same 5-year look back. And we can see how earnings were holding back the overall trend of the S&P 500 list. Now, since earnings in the petroleum sector have begun to show some signs of strength, but again, just by looking at the price movement, we know that it can be a very volatile sector. So with that piece of history in mind, I'm going to go ahead and close out of the graph and take us back to that watch list and begin to walk through the steps that Scott used to create his portfolio. I've got the date set to January 2nd of 2018. The first thing Scott did was create a quick test. We use a quick test to measure raw performance to get an idea of the foundation of a strategy before we continue on trying to prove that strategy. And so he started back on January the 2nd of 2018. And the first thing he did was scroll over on this spreadsheet after removing the petroleum stocks and determine that he wanted the largest cap stocks from the S&P 500 to come to the top of the list. So by putting my cursor over the market cap header, I can left click one time, and now this list is sorted by market cap. Not surprisingly, Apple, Google, Microsoft, Amazon, all at the top of the list. Now, the next step that Scott took was to then tag the top stocks that had a relative safety number of at least 1.25 or greater. To do that, simply hold the Control key down on your keyboard. I'm going to choose relative safety of 1.40 for Apple. We'll choose Google next. And I'll just go down the list and choose any RS 125 or greater. There's 4. There's our 5th stock. Visa is next. Home Depot, we'll have to scroll down a bit. Intel and United Health should give us 10 stocks. Actually, adding Boeing will give us our 10th stock. So there are the top 10 largest cap stocks in the S&P 500 with a relative safety number of at least 1.25. Next, we'll go ahead up to the Quick Test tab. Now here, what we want to do is just simply quick test the stocks we've selected. So I'll make sure I hit that drop down, choose Quick Test the selected stocks, and here's my return. In this case, we have 8 winning trades, 2 losers, and a 16.5% return, which annualizes out to over 25%. Now that far outdid the VectorVest composite, and if I type in the SPX here, we can see that it outperformed the S&P 500 index, the overall index, by nearly 3 to 1, about 2.5 to 1 ratio here. And so a great start. That's just an 8-month look. The next step was to take that quick test back, so let's go ahead and take it back all the way to January, the beginning of January of 2017. The system knows I'm still sorted by market cap. I'll scroll back to the top and we'll begin again. Apple still at the top of the list back in 2017. Let's tag our high RS stocks. I'll hold the control key down. 1.32, that's 3, 4. Johnson & Johnson is 5. Procter & Gamble makes the list at 6. Continue to scroll down. Walmart is 7. Comcast makes number 8 on our list. Finally, Home Depot and then United Healthcare rounds out our top 10. Once again, we'll go to the quick test. We'll quick test the selected stocks. And this is, again, that 1.5, or a little over 1.5 year look back. Now in this case, we've got 9 winning trades, just the 1 loser, and just fractionally down at 0.84%. That gave us a return of 53.87% and still just about doubled the performance of the overall S&P 500 index. So pretty good information to start with. I'll go ahead and close that. What we can do next is go ahead and quick folio those selected stocks from back in January of 2017. So if I quick folio those selected stocks, and we can just name it large cap 500 stocks using relative safety. You can enter any name you choose. Make sure you choose purchase type as long. You can set any numbers you want to there that fit. We're going to use the $100,000 and a $9.95 commission, and I simply click OK. And all I did was set up a model portfolio that now resides over in the Portfolios tab. And again, we can see here a nice equity curve with a return on investment. If we sort there, we see again P&G was our 1 loser, and again just fractionally. Amazon up at the top, over 152% return. Again, this is just over a year and a half, beginning back in January of 2017. That's our quick test and our quick folio. Keep in mind, so far we have not used any money management techniques, so there's no stop criteria on these at this time. Remember, we are in a bull market scenario. We'll talk more about that in a moment, but without the stop criteria here, we've got a pretty good return. Let's go back to the Viewers tab, and let's put this to a little bit more of a test. I'm going to now take this back for a full 5 years. So if I go back to 2013, and I'm going to take it right back to August the 23rd, so I'm just going to go back 5 years from the time of this presentation, and we're going to take a look at market cap and the stocks that reside at the top here. Scroll up, and once again, we'll walk through the same process. Apple has an RS of 1.36. We'll take Google, of course. Johnson & Johnson, that's 3. 4. There's our 5th stock. 6, 7, 8 is Qualcomm. Disney, and finally Home Depot are going to round out our top 10. Again, this is from 5 years ago. Let's go ahead and quick folio those selected stocks. And I'm just going to make this the large cap 500 RS, and we'll call it the 5-year portfolio. I'll go ahead and click OK. Let's open that portfolio. So here we've got a portfolio, once again, with these stocks in here. We bought and held these stocks over the past 5 years. We've got a 138.5% gain with a total value in our portfolio of $238,000. So we've more than doubled our money in that 5-year span. So far, a pretty powerful technique. Once again, that is with no money management techniques in place. That's just a buy and hold look at this model portfolio. I want to go ahead and back test it now. To make this easier and so that you can do this at any time, what I'm going to do now is go ahead into the Unisearch tab, and create a search using the process that Scott had followed. From the Unisearch tab, we've got a clear slate here. I'm going to go to the icon tray here, and the first icon is where I can create a new search. That's where you'll click to create this blank screen. In the parameter box, I'm going to put two very basic parameters here. Number one, stocks, capital appreciation, relative safety. That number has to be greater than or equal to a custom value of 1.25. The next parameter, I'm going to again put my cursor over stocks. This time I'm going to filter by that watch list that we just took a look at. The stock watch list in question has to equal the S&P 500 watch list that excludes the petroleum sector. It's the S&P 500, no petro. Click OK. Those were the two things used in our quick test and quick folio so far. Now the final step is to make sure we've got our sort right. Remember, we want the largest cap coming to the top. So when I click on the default sort of VST descending, it brings up our primary sort and the ability to change the sort. Now there's a long list here. If I go alphabetically and I'm moving up here, all I have to do is get to the M's and choose market cap. So they're now market cap, the largest market cap coming to the top of the list. And that's it. I choose run search. And as of right now, again, the familiar names. Now this is a list of stocks that won't change much over time. Some will come in and out, but for the most part, we're seeing the same familiar names here. To save the search that I just created, simply come over to that same tray of icons, choose the Save tab, and then Save As. This box will appear, and I'm going to name our search Large Cap 500, and I'll just put RS on there as well. Now, because most of the searches I'm used to using anyway are found in the retirement portfolio, I'm going to go ahead and highlight the Searches Retirement folder. You can put it whatever folder you'd like. I'm going to put it in the retirement folder. The search type is long, and I'm going to click OK. So now within the retirement folder of your VectorVest program, you have now saved a search called Large Cap 500 Relative Safety. With those steps complete, I'm now going to go back up to the main toolbar, and I'm going to choose the backtest tool. And let's go ahead and backtest this idea. If I simply choose to build a custom trading system, I could use the confirm calls as my entry point. The automation rules, I'll first choose my search. I'll scroll down to the retirement folder, choose retirement. At the bottom of the list is the search we just created. Now our quick folio did not have any stop criteria in place, so let's go ahead and set some criteria here. And what I'm going to do is use a gain loss. Remember, we don't want to turn this into a trading account. It's a very low maintenance, very few trades done here is our goal. So in the gain section, I'm going to fill in a gain of 999%. In other words, I'm just going to let my profits run to the upside. To the downside, I'm going to take my loss to 20%. I'm going to leave it wide enough to allow for some fluctuations in the market, but for those who desire that safety net, right, and that peace of mind of knowing there is at least a line in the sand here, we're going to draw it at 20%. We're going to use 10 stocks. We're not going to close any positions unless they're stopped out by their stop criteria. During confirmed downs, we're simply going to take no action. I'll choose finish, and that sets up our backtest. Now I just need to choose the time frame. So I'm going to use, again, that same idea of a 5-year look back, and I'm going to do it as of August 23rd of 2013. That's a 5-year span, and let's go ahead and finish and run that backtest. Okay, and for the sake of time, I paused that while it was running through the backtest, and as it finishes up here, we can see that we've had some very nice results. Over a 5-year period, we've had 90% winning trades. The total value of our portfolio is now $240,000. That's a 140% gain, annualizes out to 28% per year, with a compounded rate of return at just under 20%. So once again, in a 5-year span, using a strategy that created, when we look at trade history, one round-trip trade, and that was in Qualcomm. That was the only losing trade we had through the entire time frame. So we had one trade stopped out to the downside, a 140% return, again, doubling our money over a 5-year span. Some important side notes. When we come to the Holdings tab, all recognizable large cap stocks, we all know these companies, and we can see the returns here, all winning trades or winning positions that are currently in the portfolio. And if I come over here to the left and choose the watch list tab, what's an important point to make is that this capital appreciation that we're looking at doesn't even take into account the dividends. Now, not every stock from the list does pay a dividend. We know that Google, Amazon, they do not pay dividends, but some of these stocks do, and some pay a very healthy dividend. So the yields are here, 1.36%, as high as 2%. If I scroll down, Cisco's paying 2.87% yield. And so these dividends are not calculated in this number over the 5-year period. So it's important to keep that in mind. The power of compounding dividends if you reinvest them, or the luxury of withdrawing them for whatever purpose you see fit, is also there. But the idea that we are getting paid on most of these stocks over that same time frame. Now, we're aware that we are in a bull market situation where earnings continue to rise. But I wanted to take a moment to remind you that VectorVest has always got your back. We know that when the next bear market scenario comes, that we're going to be there to let you know, to tighten stops, to take other strategic defense techniques to protect your portfolio. And just as a couple of quick examples, remember, back in 2000, on March the 10th, Dr. D wrote in the strategy section and talked about the price of the VectorVest composite rising, but the buy-sell ratio was sounding alarms. And that he recognized then, the VectorVest program recognized then, that a major downturn is likely. A week later, the strategy section read that prudent investors should protect profits and take defensive actions, such as buying puts, and that Dr. D suggested a bias to the downside. Just 3 days later, we got a confirmed down call. And for those who remember, from 2000 to sometime in early 2003, the market had a pretty long bear stretch at that time frame. It happened again in 2007. In November of 2007, Dr. D's essay talked about contra or inverse ETFs. These are ETFs that you can use to hedge or make money in a downtrending market. And he ended that essay with a word to new subscribers and said that the confirmed down signal that we received yesterday could be the entree to a long bear market, he wrote. He went on to say, don't be deceived by the endless parade of experts who will appear on TV telling you to buy stocks. This is not the time to buy stocks. Again, that was Dr. DeLito and the VectorVest Views on November the 2nd of 2007. I don't know that I have to review the history of what happened shortly after that and in through 2008. The confirmed calls of the VectorVest timing system have never missed a major market move, and they never will, based on the criteria that make up those calls. So while we enjoy this bull market run, know that the VectorVest program will alert us when that next bear market is around the corner. And so, by employing a low-maintenance, prudent strategy that's able to more than double your investment in just a 5-year period, is, I believe, an amazing return at 28% annualized, at just about 20% compounded rate of return over time, and it's an amazing way to build towards your retirement. Whether you are 25, 35, 45 years old, starting now, investing in these type of companies will help you as you get closer to retirement, and it will allow you to retire with the peace of mind that you deserve. And finally, once again, being able to double your money over a 5-year period is, according to Dr. D, how you become a happy camper.